Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review for the week ending 3rd of October. It was a short week, 4 days of trade. Market was coming off this huge selling bout of 9 sessions of red candles, and it finally turned around on Wednesday, and Friday was a follow-up day. So we'll talk more about the markets in a bit. From the research desk this week, we had fantastic stories about rate cuts when they happen near all-time highs. What is the impact on stocks and gold? Um, the rising prices of iPhones around the world and the impact of various tariff structures around it. There was a story on that. How China has shifted its export strategy. There's a case study there, and US nominal GDP growth surprising everybody. While people were calling for recession, markets continues to rally. A story on that. So from our research desk, there was a good amount of curated stories. Do read them on the Weekend Investing blog or in the newsletter. Uh, Disclaimer as always, anything that you will see in this video is purely for education purpose, and there's no guarantee of performance. Securities are for illustration. There is no recommendation in this video. Subscription, please do subscribe to the channel. Um, that's my weekly request to you. So when we see the daily chart of Nifty, you see that in this week we had 2 down days and then 2 up days. Nifty is sort of making a very strong support zone around 24,300 to 24,600. So we have now tried countless number of times to come down and always finding support somewhere near there. So that is now a longer term support, so as to say. Almost 6 months have been spent in trying to support this range. So if we do break down at some point, it is going to be a very big breakdown. But most likely than not, we will hover around here till we find tailwind for the next move up. On the weekly chart, you can see we moved up almost 1% this week after the drubbing of the last previous week. But again, seeing everything in context, this huge rally that we had from November 23 till September, October 24, this is getting digested right now. And once this will get digested, we'll get another one of those. That is the sort of likely outcome of this. US markets continues to rally very hard, as I said in the opening, 1.09% this week. There is no sign of stopping. If you compare it with Indian markets, we topped out somewhere here, and we went down, while US markets have continued to rally very hard since September 24. So very very different dynamics from between the two markets. The gold chart is defying gravity. Gold is up 3.47% just this week. And you can see here there's one, two, three, four, five, six, seven green candles on a continuous basis, which is not usual, or one can say that this is a rare occurrence also of having seven continuous weeks of rise in gold. It had happened earlier in 2024 as well, and nearly we had it here, but not so much. So not so rare, but the extent of the pull from nearly 9900 rupees to a gram to 117, which is almost what 17 or 18% within a span of less than 2 months, is certainly pointing to things not being so right in the whole world, basically. Not just about India, because Indian currency also is hovering at its lowest versus the USD. USD is at a low versus a lot of other currencies, so we are getting double hit. So we are low versus dollar, and dollar is low versus other currencies. So our purchasing power is getting smashed, and gold is that only asset which is helping us maintain that purchasing power. So when you invest in gold, think of it as you're preserving wealth. What you're gaining actually is only nominal terms. You are preserving wealth because everything is going up, inflation is up, everything is getting more expensive. So the rise of gold actually means that other things are uh, inflating very very rapidly. and the US dollar and other fiat currencies are actually going down versus gold. So typically, when we talk of some value or pricing, we say, gold has gone up 100% in the last 2 years. Actually, gold is where it is. The currencies are falling versus gold. They've fallen 50% versus gold. So we have to start, at least I would like to think that way, that we have to start thinking that this currency business is actually the volatile and inconsistent money business. Gold is actually the real money, which stays inert and stable. Everything else is fluctuating versus gold. So I'll not waste too much time on that. Dollar index 0.5% down this week. Dollar index, in fact, has been stable. I was expecting dollar index to crash in the last few weeks. It hasn't so far. Um, the US administration also wants this to go down, but it hasn't so far. They have managed. Trump came into office somewhere around here, January 20th, I believe, um, and he has very nicely managed to uh, have the dollar index go down here from 109 till 97. But I think the next leg will start sometime sooner or later, and we will see the dollar index go down much more rapidly. That should help gold. That should help money flowing towards emerging markets. In global indices overview, this is a very unique chart. All indices are reset in dollar terms so that they can be compared. This week, we had Brazil go down 1%. The best performing um, indices are Hang Seng 3.8%, FTSE 3.3%, very surprising. Nifty also 1 to 1.4% up. Um, Nasdaq is also similar range 1 to 1.3. Canada is doing well 2.2, and Australia at 2.5%. Europe also is somewhere near 2.6. Over the last 1 month, Hang Seng China has done the best, followed by Nikkei. And again, remember, this is dollar terms. So Nikkei doing 7.9% in dollar terms is huge. Nasdaq also doing 4.9%. Europe is 6.5, and India completely flat. Over 3 months period, India is the only sorry state out there. Hang Seng, Nikkei, Nasdaq, and Russell. Over 12-month period, we are still negative. Germany, surprisingly, is doing the best at 35%, followed by Nasdaq. Over 3 years, which is now CAGR returns, India is still losing versus others, 9.8 to 12.2%. Germany is at 32% CAGR. Nasdaq is at 26.8. Europe is 24.7. And 5 year returns, we are comparable to anybody out there. We are at 12.5 versus 15. And Hang Seng actually is very poor over 5 years. Nikkei, Australia are also down. So over 5 years, we've done reasonably well. We are almost at the leadership position. But over 3 years, 1 year, and more recent times, we've not done so well. Global indices momentum score is Nikkei and Hang Seng in the lead, and then you have US, Europe, etc. We are completely at the bottom of the chart. It's not good news, but that's where we are. Also, maybe there is cyclicality in this, in the sense that you saw how Germany is doing the best right now, but 5 years back they're not doing so well. Uh, Hang Seng is doing very well in the last 2 years, but over a 5 year period, they haven't done well. So there is some cyclicality to this, and money will basically move and keep rotating. It will not just stay in one place. Of course, US has absorbed or attracted a lot more money than it should have, perhaps, but that's where we are. Benchmark indices for Indian market. Uh, Last 1 week has been reasonably all right. Mid cap up 2%, small caps up 2%, Nifty next 50 1.8%, Nifty is up 0.97%. Again, for 1 year period, we are all still negative. Nifty next 50 is almost 10% negative. That's a huge cut for 1 year. Uh, Small caps are also down 6.4%. Over 3 years, we have very decent CAGR. In fact, small cap and mid cap is far above long term averages. Nifty is slightly above long term average. And over 5 year period, also Small cap and mid cap have really hit it out of the park at 27.5%. These are index annualized returns. So some strategies perhaps will be doing much better than this also. So we've had some great years in the recent half decade. So we have to be satisfied with some years of poor returns as well. Sectoral overview this week: PSU Bank standing out 4.4%, metals standing out 3.9%, defense doing 2.3, private banks 2.5. These were the notable entities. Public sector enterprise also 2.8%, and others between 1 and 2% mostly. There was no negative sector. In the last 1 month, PSU banks have stood out, metals have stood out, and defense has done well. Over the last 3 months, autos have done well, metals have done well, and PSU banks. So PSU banks have been doing reasonably well over the last 3 months in different periods. In the last 1 year, you had defense and capital market to do well along with PSU banks, and media. IT has done the poorest over the last 1 year. Energy has done poorly. Real estate has done poorly. Over a 3 year period, defense and capital market are leading with central PSEs, PSU banks, and PSEs. So PSU banks are the common sort of theme across different periods. And once again, over 5 year period, also defense has done the best at 60% CAGR. CPSEs, PSEs, PSU banks all doing well. Real estate also, despite the recent drubbing, 32.4% CAGR over 5 year period. And what's missing out on all the action is oil and gas, which is virtually zero. Media is 0.2. IT is 11% CAGR on 5 years. Pharma is 13%, which is by itself not so bad. FMCG 13%, but when you had opportunity in other sectors over this last 5 year period, why would you stick to sectors that are not outperforming? So this again brings forth the whole idea of sector rotation, of opportunistic sector rotation, that be in sectors which are performing when they're performing, and move to other sectors when they stop to outperform. So currently we have PSU banks, metals, defense, and autos in the top brackets. Autos are recently slipping off. Uh, you had the last four rankers. These are the backbenchers, you can say: FMCG, media, real estate, and IT. These are sort of touch me nots for the situation that we see right now. Uh, on the weekly advanced decline stats, we have a mixed equal sort of situation: advances to declines, not much uh, bias towards any one side. Drop from 52-week high stats has not changed much. We still have significant number of stocks in 20 to 50% kind of drop from 52-week high. So unless you have a strategy which is going to kick out losers, you may be saddled with a lot of losers for a lot of time, and that is very, very painful. The whole idea of investing, in my view, is that you should not be in pain and uncertainty for too long. If there is pain and uncertainty, you have to get out of there, um, and go to more safer zones. um, it's just like, when something is suddenly there's some crisis of some kind happens to you. Do you stay in the crisis hoping that it will go away, or it may worsen, or do you move to a safe zone, um, and wait for that crisis to get over? It's the same exact life concept, that when you know whether you take any action or you don't take any action. Percentage of stocks which are outperforming benchmarks. In this last 1 week, we saw CNX 500 do 33% stocks are outperforming its underlying index, which is not great news. Nifty also only one third stocks are outperforming the benchmark. So not much action from that front. Strength and weakness within benchmark indices. So Golden Cross is 68 and 70% on large caps, which is decent number. Mid caps and small caps also 61% stocks are in Golden Cross. So you will get a lot of setups, bullish setups because of this. Brutal strength, where price is greater than 25 DMA, is greater than 50, greater than 200 DMA. Uh, Almost one quarter of large cap stocks are in brutal strength, so which is a decent number. Mid caps and small caps are still low. So currently, the bias in the market is stay towards the larger cap segments in the market. That's where most opportunity is there. And brutal weakness is more towards small caps and micro caps. So you will have a lot of pain in that space right now. Brutal weakness examples: Nifty, TCS, ITC, HCL Tech, Wipro, Trent, Tech Mahindra, all in brutal weakness. So ideally, you don't want to be there. And Nifty Next 50 also has VBL, Lodha, ABB, Indian Hotel, Bajaj, HFL, Naukri, REC, United Spirits. This is also brutal weakness. These are just examples of brutal weakness based basis the formulation. This is not advice at all. Uh, and you would have seen that while momentum strategies were doing very well, they had Indian Hotel, VBL, RECs, and now because the trend is changed, they would be getting out of those places. You would not find any of these stocks also in any momentum strategy. So the basic nature of automatically solving for weakness is there in momentum strategies. Number of percentage of CNX 500 stocks above 50 and 200 DMA. So when we see 200 DMA stocks, we are exactly at 50%. Not so good, but not so bad. And 42% of 50 DMA. Again, this is not good. If you want this to be more near 60 and 70%. So not so great trend check right there. In the percentage of stocks above 200 DMA of various sectors, you'll find most opportunities in autos, metals, commodities, financial services, private bank space, where most of the stocks, 80 to 93% of stocks, are above the sectoral 200 DMA, which means that they have some core strength right there. And you'll find IT, real estate, FMCG, pharma, even public sector enterprise having 50% or less of the stocks above the sectoral 200 DMAs. When we look at the FII DII stats, we find that FIIs continue to sell, although lesser than last week. We had 2,800, 2,300, 1,600 and 1,500 crores kind of sales. And buying was reasonably good from DIIs. All 4 days of buying, a little less on 3rd of October, but the trend continues of buying versus selling. So cumulatively last month now, FIIs have sold 38,000 crores, DIIs have bought 68,000 crores. So net institutional money is flowing through, institutional and retail, of course, through the institutions. This is what is giving reasonable stability to the market. Otherwise, if we just had um, a down move from FIIs and no inward coming in from DIIs, we probably would have been at 21, 22,000 Nifty. So that's where we are for this week gone by. Not such a bad week. I would hope for better weeks going forward. Do let us know about this content, whether you're liking it. Some things that you don't like about it, do let us know. We are constantly experimenting and updating our data points. The global data points was a suggestion by some users, and we've implemented that. Um, I think those are unique data points which are not available anywhere, in dollar terms to compare different markets. So we will keep doing such innovation. Uh, Certainly, your feedback, your support, and your subscription to this channel would go a long way in giving us a lot of more motivation. Thank you and have a great weekend. Bye.